Tell me if this sounds familiar. Revenue is up. The trajectory is looking great. You're hitting targets you have never hit before in your business, but you're still stressing to make payroll every pay period. You are trying to figure out how the hell you're going to pay those taxes that are due on that giant revenue. And I can tell you it's because you've been making this one mistake. If we haven't met, my name is Allison Duffy. I am a CPA. I've been doing this gig for about 20 years, and over that time, I have worked with hundreds of business owners and have had my own businesses. My parents have a business. My sister has a business. We are a family of entrepreneurs, and I can tell you, I have seen a lot, I have learned a lot, and I get it. So, what takes people down when it comes to business and whether we're winning or losing? It's not going to be taxes. It's not necessarily having the wrong entity structure. It's not necessarily forgetting deductions, although don't do that. The number one reason that people struggle to correlate the high revenue numbers and the struggle to make payroll is because you are running your business from your bank account. Let's dive deep. When cash goes up, you feel successful. All of a sudden, it's like that breath of fresh air. Great, let's pay off the debt. Great, let's make that investment. Great, let's pay bonuses. Let's start glowing up in our lifestyles. But then cash goes down because maybe somebody took too long to pay you, and we're back to sweating bullets. Staying up late at night, how am I going to cover payroll? How am I going to make those 401k remittances? How am I going to stay on top of my sales tax compliance? And that's why we can't run a business from our bank account. This is where accounting becomes so important, because if you are tracking transactions in, we are tracking that revenue. When you are spending money, or even better, if you're anticipating cash flow needs, you can start to predict what's going to happen instead of waiting for your bank account to tell it to you. So, example being like, the taxes are going to be coming due, or that insurance payment that covers the whole year is coming due. And so by having a strong accounting system, you're going to be able to anticipate better what's coming down the pipeline in terms of your cash flow. The other really powerful thing about this is that if you are paying attention to your accounting and you do invoice, this is going to give you a direct line into who owes you money. And if you need to get cash, who you need to go talk to. Hey, your AR balance is 60 days overdue. What's your plan? Because I promise you, squeaky wheel gets paid. So I'm going to talk from my own personal experience. I, last year in 2025, started the business in 2021, had tremendous growth. I've been averaging, I think, between 27 and 30% growth year over year in terms of revenue. So 2025, I have my best year for revenue, hit new levels. Of course, it wasn't my budget amount because I always am like the super stretch goal kind of girl. But at the end of the day, what I realized is that the amount of money I took home actually went down almost 20%. So even though my revenue went up 30%, I took home 20% less year over year. That was the first time I really started to step back and go, you know what? Revenue's great, but if I am working so much harder to keep these top line numbers growing and I'm getting paid less for it, that's a problem. So how did this happen? And I think this is a really common story, but it's an important part of the process. We're growing revenue. So I'm in a service business. So I'm growing revenue. I'm either going to have to change a process, which probably includes some investment, or I'm going to expand capacity of people who could do the service that I provide. So I'm expanding payroll. So my overhead went up, and it wasn't outrageous. It wasn't like, oh my gosh, everybody got new computers, everybody got new desks. We did move into a bigger space, but financially it made sense. And so even though we were able to gain the growth, my profit margin got compressed quite a bit. But what's nice is that now I have the growth And it's a matter of retaining it. What I can do now in hindsight is I can kind of go back and go, okay, well, let's look at our software subscriptions. Where can we cut? Somebody ended up leaving, so that took care of that headcount problem. If the cost of my growth is sacrificing my profit margin, then I need to be really thoughtful about what my objectives are. Is my intention to continue to grow, to try and grow revenue? Or is my intention really to try and equalize it? Revenue grows, but net income stays the same. I mean, in terms of profit margins, it grows together. Or am I going to say, you know what, this revenue growth isn't worth it if it means that, you know what, maybe I scale down to a lower revenue amount, but I reduce my expenses so my net income or my profit margin is even higher. And, you know, without having good accounting in these data points, you can't really see what your business is. So 3 numbers every owner needs to know. What is your profit margin? For every dollar that you make in revenue, how much of that do you get to keep? Is it 30 cents? Is it 40 cents? Is it 10 cents? Without knowing that, it makes it very hard to know what your growth is costing you. And so that's a really important one. Number 2, cash runway. If your business hits some kind of and you didn't make any more money for the rest of the year, how long could you keep your business afloat with the cash you currently have? And that is a scary question. I'm also going to say it might be cash, but it also might be having an available line of credit to buy you some time to figure out how to pivot with whatever nightmare circumstances just hit your business. Number 3, gross margin. So this is going back to that growth. So this is the difference between your sales price and what it costs you to produce that sale. Very specifically, like if we got into the sale of tangible goods. I have a pen, I sold this pen, but you know what? I lost my supplier and now the different components to this pen have gone up. And so now the amount of gross profit I get from the sale of every single pen has gone down. So now it's going to be harder for me to cover my overhead. So this is another one that becomes very important. Likewise with my headcount. You know, I'm in a tax business. I hire somebody to do taxes, but I hire them for the entire year. They are very affordable during tax season, but in the summer when revenue is down, they become very expensive. So what is the direct cost of me to have that growth by being able to do additional tax returns, knowing that that person's still on payroll over the summer? So this week, instead of checking your bank account, which I'm sure is the thing that indicates whether it's a great day or really terrible day, take a look at your accounting. Go into your financials that you've got. First, kind of assess the health. Are we staying on top of this? Do we feel good about these numbers? Do we need to spend a little bit more time here? And then secondly, calculate those 3 metrics. What is my profit margin? What is my cash runway? How long can I operate this business if no more revenue comes in? And then lastly, what is my gross margin? What does it cost me to produce $1 of revenue with just those direct costs? And so this week, our freebie in the Founders Resource Library is going to be a business financial checkup worksheet that's going to walk you through these 3 numbers and help you assess the financial health of your business all in about 10 minutes. So I'm going to put a link in the show notes below. You can take a peek at that. It's all free. And once you sign up, you will have access to all of the financial resources that we've created. We're still in early stages, so save the link because we're going to keep adding every week and hopefully build a really great library of resources to help you navigate this. All right, like and subscribe.